Hi there, and welcome back to the Business Career College video series. We're going to look at the Registered Retirement Savings Plan in some detail in this series of videos. There is a lot to know about RRSPs, and we're going to try and cover off a fair bit of the detail here. So we'll be looking at the Registered Retirement Savings Plan, or the RRSP. Now, before we get into any kind of detail about the RRSP, the first thing that I like to do always is to dispel a couple of misconceptions that I quite often run into around the RRSP. And the first is just around some of the terminology, and you'll hear this all the time. We'll hear this at tax time often, where somebody says, I went to the bank today and I bought an RRSP. There's no such thing. You don't buy an RRSP. What you're actually doing here is you're using some sort of investment within your RRSP. So what you'll do is you'll go buy something like a stock, a bond, a mutual fund, a segregated fund, something like that. And the financial institution that sells you that investment will register it for you, and then it becomes part of your RRSP. All that means is that you have some particular tax advantages associated with that investment now that you wouldn't have if you invested on a non-registered basis, and some tax restrictions as well, which we'll talk about as we go through this section. The other misconception, which is less frequent today, is around risk. Occasionally, I'll run into the misconception that you can't lose money in your RRSP. I think most people were disabused of this misconception in the wake of the 2008 credit crisis, where we did see a lot of losses within both registered and non-registered accounts. Okay, so where are we going to start then? Let's look at who can contribute to the RRSP. So we're going to look at contributions into the RRSP. In order to make a contribution to the RRSP, you have to have earned income and be a Canadian resident. And what we do here is we take your earned income times 18%. Okay, that 18% is so frequently an exam question on all kinds of financial services exams, you absolutely must know that. Now, there is a maximum. The maximum varies year over year. So for example, for 2013, that maximum is $23,820. You'll generally be given that figure if you need it for exam purposes. And for 2014, that maximum is $24,720. That figure is indexed, so it's actually legislated that that figure grows with inflation, and that's why we see these changes year over year. When you make a contribution into an RRSP, then what happens is you have a tax deduction, which is the first of our tax advantages associated with the RRSP, and I would suggest that's the one that most people are most aware of. That tax deduction means that basically you're not paying tax on the income that you are contributing to your RRSP, at least not yet. Now, the other thing to note about the RRSP is that there is no minimum or maximum age at which you can contribute to an RRSP. Many financial institutions will not allow somebody under the age of 18 to hold an RRSP, and that's fine, but the Income Tax Act doesn't prohibit contributions. And many of you are probably saying, well, hang on a second, I know I can't have an RRSP past the age of 71. That's absolutely true, and we'll deal with that in more detail in a few minutes. So how can I possibly contribute to an RRSP after 71? Well, I can't contribute to my own, but there are two people whose RRSP I could contribute to. I can contribute to my own RRSP, or I can contribute to a spouse's RRSP. So the ability to contribute to a spouse's RRSP means that if I'm beyond the age of 71, but I happen to have a younger spouse, then I can still make RRSP contributions on a spousal basis. Okay, so when you contribute to the RRSP, the other tax advantage that you'll have here is that the growth, hopefully, growth is not guaranteed here, you certainly can suffer losses, will be tax deferred. Unlike other investments, normally, for example, if I hold a mutual fund or a stock or a bond or a segregated fund, and it generates some sort of returns for me year over year, I will have to pay tax on those returns. In this case, though I don't, my returns here will be tax deferred. Now, just while we're on the subject of the investments that can be held in the RRSP, a frequent set of exam questions rotates around what you cannot hold in your RRSP. And one of the big ones that you cannot hold in your RRSP is real estate. There used to be more restrictions around precious metals, but today there are some precious metals choices you can have in your RRSP, and there are some derivatives contracts you can also hold in your RRSP, but real estate is still a big one. And then another thing that you can't hold in your RRSP, at least not directly, are your collectibles, things like your collection of fine art or whatever you have. And there are ways to hold real estate and even collectibles, but those are going to be through funds where you don't have a direct investment, but rather you have an indirect holding of those investments. So what's going to happen now with your RRSP is you're going to have this growth, but you will have to mature your RRSP at some point by December 31st of your 71st year. Okay, that's not to say that you have to wait that long. In fact, you could mature your RRSP anytime you want, but you have to do it by that time. So you could do this at 25, although it would be an unusual decision. You could do this at 50. You could do this at 60. You could wait right up until the last possible minute and do this on December 31st of your 71st year. That is the year in which you turn 71. Now, when you mature your RRSP, you will have three choices as to what you do with that. And the choice that I think most people consider today is the Registered Retirement Income Fund. The RIF. And basically, the RIF is very much like the RRSP with a couple of notable exceptions. That is, you can make no more contributions, but you're still going to have investments. In fact, still choosing from the same range of investments as you chose from with your RRSP. Most people, when they move from the RRSP to the RIF, just keep the same investments they previously had. They may do some rebalancing, which we'll discuss elsewhere. They may do some rebalancing, but really, all they're going to do is just roll whatever investments were held in the RRSP right into the RIF. And then the other characteristic of the RIF is that you have a forced annual withdrawal. You actually have to take some money out of the RIF each and every year. Okay, so that's one of your choices. Other choices that are available are an annuity. This would be a registered annuity. And a classic decision here is whether or not I'm going to use a RIF or an annuity. And generally, with the RIF, I'm still invested. and I have the risk associated with investment, which also means I have the opportunity for greater returns. With the annuity, I'm going to have a fixed income. I know exactly what my income will be, but I take out the risk, and therefore I take out any opportunity for better returns. So no additional returns here. So if I'm looking for fixed income for the rest of my life, I'm going to choose the annuity. If I want to still be able to benefit from market fluctuations, I'm going to choose the RRIF, or to choose from a wider range of investments, I'm going to choose the RRIF. There is a third option. It's to take it as cash, which might sound unusual. The problem with taking cash is that you would end up with all of your RRSP taxable then in your hands. But if you have somebody who has a relatively small RRSP, they could they could just mature the RRSP and take the cash. Whatever you do, the dollars that end up in your pocket, the dollars that you can actually spend, are taxable. And they're taxable as ordinary income. There's no particular tax advantage to those dollars. They're going to be taxed just like any other kind of income. Okay, so then you do have the opportunity to make withdrawals from your RRSP anytime you want. In fact, you can make a withdrawal anytime you want. However, those withdrawals are going to be subject to a withholding tax. We'll talk about that withholding tax in another video, unless you withdraw those amounts for one of two very specific reasons, and those are the home buyer's plan, which we'll also talk about in another video, and the lifelong learning plan. So that's the broad overview of the RRSP. There's a lot more detail to go into, but that gets us started. While I have this picture up on the screen, I want to point one more thing out, simply because there's a lot of confusion that I run into, especially with newer students around the RRSP, and that is we're going to have this whole alphabet range of plans. In fact, when we look at these investment options over here, you'll see the same investment options with You have the same options or the same choices when you're using a RRIF, when you're using a LIRA, when you're using a LIF, and then a whole bunch of other tax advantage plans give you very similar choices. It gets to be a little bit of an alphabet soup, and it can be confusing. So what I like to show students is that if you keep your R's together, I know it's corny, but if you think like a pirate here, keep all your R's together, okay, that will help you to recognize what plan fits where. So the RRSP and the RRIF, these guys fit together perfectly. You'll go from RRSP to RRIF. You don't go from an RRSP to a LIF, and you don't go from a LIRA to a RRIF. Okay, you go from RRSP to RRIF. You have other choices, of course. You also have cash and annuity, but you stick your registered plans together, the R's all fit together. I hope that's helpful. I hope you learned something about the RRSP and you're able to proceed through the remainder of the video series covering the various registered plans. Thank you very much.